housing market is reaching a pivotal moment right now. You see, some investors believe a Fed pivot is coming soon, and if that was to happen, that would completely change the future outlook of the housing market as we know it. Well, as you know on this channel, we've been expecting that we're going to continue to see price declines take place the rest of this year and into 2023 as long as the Fed sticks to the original script and continues to fight inflation down to the 2% levels that it said is their ultimate goal. So there's a lot of interesting dynamics going on right now in today's housing market and in general with the Federal Reserve and the economy as a whole. So there's a lot to talk about in today's video that I'm excited to get into. But before I get started, do me a favor and support the channel by smashing that like button. And if you haven't already done so, definitely subscribe and hit that notification bell to watch more content like this. And with that said, let's jump into it. The future of the housing market is going to be dictated by the decisions that the Federal Reserve makes in the coming months ahead. Now, I've personally been fully on the train that we're going to continue to see house prices correct from where we're at now. We've so far seen house prices correct and go down 7% from peak levels, and personally, I do believe we're going to continue to see them go down from this point on. Now, we've been sitting around these levels for around the last month, according to the latest numbers from Redfin, but really the main cause of that is these homes that have been selling are homes that were really listed back in July and August, back when mortgage rates were really at 5% levels. You see, the median sales price is a very delayed metric because typically homes close anywhere from 30 to 45 days and sometimes even longer than that, not to mention the time that they have to sit on the market. So the homes that were bought using 7% mortgage rates, those homes aren't really going to close until roughly around November time at the minimum, because mortgage rates only really hit 7% at the end of September. So we won't even be getting that data really until maybe the end of November, beginning of December time. Now, in a nutshell, when you take a look at today's housing market and why we've experienced the current housing market correction we've experienced so far, and why we're going to continue to see bigger corrections taking place, really comes down to affordability. And right now we're currently at the worst affordability levels we've really been at in over 38 years. Now, I personally believe that mortgage rates are going to continue to go up, which in turn will cause affordability levels to decline unless something significant happens. You see, to see things completely turn around in the housing market and start to see house prices go back up again, we would need to at least see mortgage rates go back into the 5s again. And the only way we would see that happen is if the Federal Reserve helped make that happen. You see, this is what we've ultimately been seeing take place right now. We have high inflation, which is pretty much at the source of this. That's the ultimate problem, and the Fed sees that as a problem. So high inflation leads to the Fed being aggressive with their monetary policy. That leads to mortgage rates going up, which leads to affordability levels going down, which that pushes more buyers out of the market, which in turn causes house prices to decline. So when you reverse engineer this, it really all comes back down to inflation. That's where it all starts with. And the reason why it starts with inflation is months ago, the Federal Reserve made it crystal clear that they're not going to stop being aggressive with their monetary policy until we get inflation levels down to 2% levels. Now, the way I see it, there's really only two ways that we end up seeing the housing market completely change course and start to see prices go up again. Now, the first way that this happens is we see inflation go down to those 2% levels. Now, the reason why this is not really a viable option is that's going to take a while for that to take place. That's not something the Fed can snap their fingers, use their monetary policy to immediately bring inflation levels down to that level. It's going to take time. It's going to take probably a couple of years until we finally reach those levels. So that brings us to the second way that we see this magically change. Realistically, the only way we see this happen is if the Federal Reserve completely changes their plan, changes course with direction of what they wanted to accomplish, and decides, you know what, rather than prioritizing inflation, let's prioritize saving the economy. Let's not induce an economic recession and make sure that we can save the overall state of the economy. So that would mean pausing, eventually lowering interest rates. We could possibly see that happen. That would be considered a Fed pivot if that takes place, and that could ultimately lead to mortgage rates going down and house prices continuing where they left off. So the real question that everyone wants to to know right now is, will the Fed pivot anytime soon? Well, some experts believe that we might see a Fed pivot take place as soon as early 2023. And by that, I'm not talking about a pause, I'm talking about lowering interest rates. Now, we've already been hearing talks about how they're going to slow down the initial rate increases that are coming up. There's a November meeting coming up on November 2nd where they're going to decide how much they're going to hike interest rates. Now, we've been expecting that we're going to see another 0.75% increase in rate hikes for the November meeting, but now there's talks going on in the background that maybe we might actually see early stages of a pivot and start to see it go down to a 0.5% rate hike. Even the Wall Street Journal reported on a recent Friday that there were central bank officials that already stated that they're feeling uneasy about the speed of these rate hikes taking place. Now, that could be an indication that a change of monetary policy could be on the table. We also just saw the yield curve take place between the 10-year Treasury and the 3-month Treasury. And what that means is essentially you're going to get a higher rate of return for getting a 3-month Treasury than you would for getting a 10-month Treasury bond. So that's normally a sign and an early indicator of a recession coming in the next 6 to 9 months. And if you look historically, you'll find that the yield curve typically comes right before the Fed typically pauses rate hikes and eventually starts lowering interest rates, which is another reason why people believe and investors believe that we're going to see a Fed pivot coming sometime soon. Now, with that said, we just got our GDP numbers back, and that's our gross domestic product, and that came back at a growth of 2.6%. Now, you might be wondering, well, what does this have to do with the housing market? Well, ultimately, what happened is we saw that between GDP growth and the fact that people and investors are worried about the Fed pivoting, all of that contributed to the 10-year Treasury bond yields going down recently. Now, those who follow the channel know that there's a very close correlation between the 10-year Treasury and mortgage rates. So when the 10-year Treasury goes down, we also see mortgage rates typically go down as well. And so that's actually what we saw as mortgage rates have gone down from 7.37% now down to about 7.08%. We're as low as 7.04% very recently. And so that's having an effect on the housing market. So ultimately, the future of the housing market is going to depend on how the Federal Reserve plans to navigate these next coming months. Now, what might play into their decision making is we just got PCE numbers back. That's your personal consumption expenditure. Basically tracks your consumer spending, what we're seeing with that. And what the Fed really likes to focus on is core PCE. Basically, your consumer spending not counting food and energy costs. Now, what we saw with September's numbers is we saw another 0.5% increase month over month and a 5.1% increase year over year. So what these numbers meant essentially is that we're continuing to see consumer spending stay strong and resilient during these times, even with these rate hikes taking place. And so personally, what I believe is that we're going to continue to see an interest rate hike of 0.75% because I think we're still showing signs that the economy is fairly strong at this point. Now, shifting gears specifically to the housing market, based on what we're seeing right now, as long as the Fed stays course, we will continue to see house prices decline. You see, mortgage rates will continue to climb, affordability will continue to plummet, and we're already seeing buyer demand decline rapidly at this point. The Mortgage Bankers Association just reported that again, we just saw another weekly decline of 2% for purchase applications and a decline of 42% year over year. Now, mortgage application activity in general is at the slowest levels we've seen since 1997. So let that sink in. Now, many people that don't believe a housing crash is going to happen will point to the fact that active listings is continuing to decline as well, which in turn puts upward pressure on house prices. And while that's true and a good point to make, the buying demand is actually going down at a faster speed than we're seeing the active listings go down. And in turn, we're seeing the months of supply continuing to go up. In fact, Redfin just reported that we just hit a new high of months of supply, sitting at 3.1 months of supply currently. So as long as this number continues to go up, we will continue to see house prices go down. Now, regardless of the standoff between buyers and sellers, we are continuing to see that cause housing transactions as a whole to continue to plummet. You see, the National Association of Realtors just reported their latest data for pending sales, and it was really interesting what we saw. We actually saw the pending sales were at the lowest levels we've seen. If you exclude the pandemic, the lowest level since 2010. We saw another month-over-month decline decline of 10.2% just in 1 month, and we're actually at a yearly decline of over 31% in pending sales. So with that said, if the Fed sticks to the original plan and they continue to stay aggressive with their monetary policy, then expect that house prices will continue to correct from where they're at now. But if the Fed changes course and we see these early signs of a pivot and soon after we start to see them lowering interest rates again, then that will be a sign that house prices are going to start picking up from where they left off and they will start to move back up again. So that pretty much sums up what's going on in today's housing market. I hope you guys enjoyed today's video, and if you did, do me a favor and support the channel by smashing that like button, and if you haven't already done so, definitely subscribe, hit that notification bell to watch more content like this. Also, if you have any thoughts or questions, let me know in the comments below and I'll do my best to get back to you. Finally, follow me on Instagram and TikTok at The Out of State Investor, and if you enjoyed today's video, I'm going to highly recommend checking out one of these two videos over here. And with that said, I'll see you guys on the next one.